Hey Bowtie Nation, Joseph Hogue with your weekly market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, if you don't know what that whooshing sound is, it's a sound made by shares of Nvidia, sucking up all the money in the stock market. Over the past month, Nvidia has added $781 billion in market capitalization. Now that money had to come from somewhere, and it appears it came from investors collectively selling out the rest of their portfolios to catch a ride on Jensen Huang's ticket to wealth. While shares of Nvidia were up 38% in the past month alone, 429 of the 500 stocks in the S&P 500 market index were falling. Should you join that crowd of hopeful Nvidia investors? I've held shares myself for over a year and find myself asking, how much further can it go? What should I do now? I'm going to outline the bull and bear case, building out some price forecasts for Nvidia, and offering a few ideas on how to keep riding those shares of Nvidia higher while also limiting your risk. Stick around after that. We'll do our Monday stock market update with the stocks to watch this week, including updates to shares of Nike and Walgreens. Back to our main topic and what to do about shares of Nvidia. I see daily in the comments questions from investors of what to do. Some have massive profits and don't know whether to sell. Others are wondering if it's too late and don't want to get caught in a bubble. And right now for investors, it seems those are the only questions that matter. The S&P 500 index is up just 3.1% over the past month, but shares of Nvidia account for nearly 3/4 of that. Nvidia is so big that it's weighted at 6.1% of the broader market index. Shares of the chipmaker are up 38% over the last month, and contribute 2.3% of that 3.1% market gain. Without Nvidia, the market would only be up 0.78%, and in fact, only stocks in 4 of the 11 sectors are higher for the month. So what I want to do here is first help you find a valuation for shares of Nvidia, show you how I'm looking at this stock. More importantly though, I want to give you 3 options for what to do right now: buy, sell, or hold. We're going to look at strategies for what to do if you own Nvidia, keep riding it higher and lower your risk, as well as what you can do if you haven't bought NVDA yet. First off, trying to estimate a fair price target for shares of Nvidia, investors have to wonder if this company can keep up that breakneck speed. Nvidia more than doubled sales over the last year, growing revenue by 126% to $60.9 billion, a pace you have to think slows down, but management estimates a $1 trillion market opportunity in artificial intelligence, autonomous, and digitalization. $1 trillion market revenue per year, that is still a lot of runway for growth for a company dominating the market and still at just $61 billion a year in its sales. And here 2 catalysts could drive revenue growth over the next couple of years. First, initial reports and estimates are that the company is going to sell its Blackwell GPU architecture around $30,000 compared to its H100 cards it was selling for about $25,000. But the Blackwell is going to have more than twice as many transistors and much more processing power, making it a very good deal. That alone should drive strong adoption for the new model and further win that market share. Another catalyst here, though, is the transition from a components focus, like selling the Hopper H100 as a card, to focusing on selling the entire rack with the GB200. It's a much higher value-added strategy and should continue to boost revenue. Here we're going to use analyst estimates for next year's earnings and sales to get a back-of-the-envelope valuation. Analysts expect the company to post $3.61 in per-share earnings through next year, very strong 33% growth, but also well off that 108% earnings growth it's expected to post this year. Revenue is expected to also grow 33% to $160 billion, also strong but off the 97% sales growth this year. So yes, Nvidia is expected to continue to do very well, but with slowing growth, you have to wonder if some of that enthusiasm comes out of the valuation. In Morningstar data here, we see shares of Nvidia have traded at a 5-year average of almost 20 times sales and 69 times earnings. That is very much below where they're at now, a price to sales of 41 times and a PE ratio of 76 times, but also well above the low points over the last 5 years of 13 times sales and 60 times earnings. So just putting some of these together, if we apply those estimates for $3.61 in earnings and $160 billion in revenue to the average valuation multiples, we get an Nvidia price forecast between $130 a share. That would be 20 times revenue times $160 billion, then divided by the shares outstanding, and then $249 each, or 69 times the PE value of $3.61 for the end of next year. Now we could use the current valuations of 40 times sales and 76 times earnings also for a range of $258 to $274 a share, but with that slowing growth here, I think it's safe to expect that these valuation multiples will come down a little bit. Now at the low point, if we use the lowest PE and price to sales ratios over those last 5 years, we do get Nvidia estimates between $84 each, which is that 13 times the $160 billion sales, and then $216 per share, or about 60 times its earnings. Most of these are slightly or well above the current price, so as long as Nvidia keeps performing as expected, let alone beating its expectations, it should continue to produce those returns. So here I want to give you 3 ideas on what to do with your shares of Nvidia, or if you're trying to decide whether to buy shares or not at this point. Now understand, you can always do nothing. Hold on to the stock long term and just don't worry about the year-to-year valuations, or just buy it now if you don't own it. Sure, Nvidia may seem expensive now based on some of those valuation estimates, but even if it grows earnings at just a modest 20% rate over the next 5 years, that brings us to $6.74 per share profits. Even on a 30 times price to earnings ratio, half of the lowest estimate multiple that we've seen over the last 5 years, that's still a forecast of $202 per share and a 10% annual return. That's not what Nvidia investors have come to expect, but it's still not bad. But there are other ways to think about this, ways to lock in some of your profits, limit your downside risk, while still benefiting from that further upside in the stock. So these next 2 strategies are for Nvidia investors, or those of you that haven't bought the shares but want that upside, but you're really worried about the stock coming down in the short term. That's because data from the New York Stock Exchange shows us the average holding period for a stock has plunged from 8 years back in the 60s to just 5 months post-pandemic. That means investors are holding their stocks for less than 6 months, and there are a lot of investors out there that just don't want to wait for that long-term picture to evolve. So if you want to reduce your risk in Nvidia a little, one idea is to sell call options against your shares. This is the covered call strategy, is where you hold a stock or buy it, then you sell to another investor the right to buy those shares from you at a set price, selling call options, and for that right, they give you a cash premium right now. With Nvidia at $128 per share right now, we can go to the options available, and you can do this with monthly options, collecting that cash flow every month, or longer term options all the way up to 2 years out. But we're going to use the June 2025 call option, so about 1 year from now. I like using these longer term 1-year options because it's going to make it possible to lower our taxes to capital gains rates if that stock gets called away from you after a year. Part of this is going to come down to picking the return at which you'd be happy with the stock, or a price to which you think Nvidia is going to reach. Let's say we think Nvidia can go at least another 25% over the next year, which would give us a price target of $160 per share. Scrolling through the options available here to the $160 strike price then. Remember, this means we're selling to another investor the right to buy our shares from us at $160 each. That means we collect that $18.30 a share for selling these call options. So if we were just now buying the shares, you would pay $128 each, but then receive that $18 by selling the calls. Your price would actually be just $110 per share. Now, if you already own Nvidia, you just sell those calls and collect the money, like collecting a dividend on a stock. At that $110 cost, or an $18 dividend, you're getting a 15% discount. Nvidia could fall by 15%. And you wouldn't worry about it because you've got that cash cushion. Even if Nvidia continues higher over the next year, if shares reach that $160 price or beyond, that other investor is going to buy those shares from you at that call option. If you do the math here, $160 divided by the $110 that you paid gives you a 47% return over that year. So with this strategy, you're getting 15% downside protection and still enjoying upwards of a 47% return. But I know a lot of you don't want to give up that explosive upside return potential, so another strategy here is what's called the call back spread option. This strategy gives you the upside potential on a stock and can completely limit your downside below a certain point. I'm going to walk you through an example, but here you don't even need to pay the $130 per share for the stock. Instead, you're selling one call option and buying 2 other call options on Nvidia. As an example, going back to the options available on Nvidia, and you can use whichever months and strike prices you want, but I'm going to use these June 2025 calls, selling the $125 strike price call option to receive $30.72. So we're going to receive that money while buying 2 of the $145 strike options for $21.40 each. So here, I'm paying $42.80 each share to buy the 2 call options, but getting back $30.72 a share for a net cost of $12.08 each share. And if we chart this out at different share prices for Nvidia through next June, we see it gives us unlimited price potential return while also limiting our downside risk to just $2,700, even less if Nvidia falls apart. If Nvidia rises above the $145 strike price, then one of those purchased call options canceled out the sold option, and you're just left with the unlimited potential on that remaining call option. If the price of Nvidia crashes below $110 a share, your total losses are limited to that $12.08 per share paid for the strategy. There is a range, though, between $110 to $170 per share where your losses could be as much as $2,700, but it is a small price to pay for the unlimited upside and limited downside on a stock that has doubled over the last year. On to the stocks I'm watching this week. First up, Nike, ticker NKE, was up more than 1% Friday on an upgrade by Oppenheimer with an outperform recommendation and reinstating the stock as a top mega cap pick given the company's refocus on innovation and brand building. Shares are down 8.5% so far this year on disappointing sales in China and the US, with analysts only expecting 0.9% sales growth this year and 1.2% next. The company is expected to show fairly strong earnings growth, though, when it does report its results on Thursday, forecast to grow earnings by 27% from a year ago. Now, management has beaten expectations in 3 of the last 4 quarters, but it's going to be difficult to turn less than 1% in sales growth into 15% earnings growth for the year. Of the 27 analysts covering the shares, the average target of $111 per share is just 15% upside, while the lowest target of $75 is a further 22% lower. I gotta tell you folks, with retail sales yet to rebound in China and weakening in the United States, I'm not convinced the risk is worth it just yet. Investors may see $105 per share on a very good news, but it's not much to cover that risk of a drop or just a stagnant stock price. Next up, Walgreens Boots Alliance, ticker WBA, also going to be reporting its earnings on Thursday, with the shares falling 38% this year as the entire discount, retail, and pharmacy industry just tumbles. Flat sales and falling earnings has the company scrambling for solutions to its $30 billion in long-term debt. WBA recently scrapped its plans for an IPO to its UK-based Boots retail pharmacy chain, but said it was still looking at other solutions. Now, the IPO market in Europe hasn't been great, but it's not so bad, so it's possible they were approached with a better deal to just sell the Boots segment automatically to private equity, in which case we could hear about details this week. Now, management has been under pressure for a plan and has been selling off investments in stakes like Cencora and a Chilean pharmacy this year to pay down that debt. Earnings for the most recent quarter are expected down 29% from last year, with full-year sales up just 4.5% and profits 20% lower. Now, against this, I still believe the stock is trading at just fire sale prices at just 6 times PE, and the financial situation is not too bad given $700 million in balance sheet cash. News of a sale of the Boots segment or any other plan could send the stock back up to $20 a share. Showing you the bigger picture here with the Sector Spider's sector tracker, 9 of the 11 stock sectors closed higher last week in what was really a broad-based sign of strength. Only utilities and real estate closed lower, and that can be chalked up to profit-taking after a strong 2 weeks in those sectors. Stocks in the consumer discretionary sector did especially well despite weaker retail sales reports, lending more data to that fear of a consumer. Don't wait, the share sale is only open through July 11th, and shares are selling out fast. Don't forget to tap that subscribe button and click the bell notification.